Today we're going to talk about EBITDA. What is it? How is it calculated? How does it find its way into the valuation of a business? The acronym EBITDA, or EBITDA as some people may call it, is earnings before interest, taxes, depreciation, and amortization. The purpose of the calculation is to determine a good proxy or approximation for the cash flowing power of a business. And so when you think of it, if you look at the income statement for any particular company, you're going to have revenues or sales minus costs of goods sold, the wood to make the pencils, and then you're going to have gross profit. So you can almost think of that as the unit economics of the business, the profit on the sales of a product or a service before you get any of the operating or supporting expenses incorporated. Then you take out the operating expenses for the business. That's salaries for the people, that's rent for buildings, it's software, it's service providers, it's all of the other things that go into the running of a business, and that leaves net income. And so net income may initially seem like, hey, that's pretty much the profit of a business. However, there's things that needed to be added back to make it a more apples to apples comparison across different businesses and a more accurate representation of the true profitability of the business. So let's walk through each of these categories. First, you have interest. Interest is the cost of debt. And so if I have a lot of debt on my company, then there's going to be a lot of interest costs. If I have a little bit of debt or no debt on the company, there's not going to be any interest costs. And so it's not necessarily indicative of the true profitability of the business. If you bake in the interest expense, it's more of an indicator of the capitalization or how much debt's on the business. So in the EBITDA calculation, you eliminate the interest expense or add it back, because that debt, which usually when a company is acquired, the seller has to pay all that debt back. Think of like paying the mortgage back on a house. And so it's not really relevant for gauging the profitability or the cash flow generating power of a business. So next is taxes. Now, given that everybody's tax situation is different depending on which state, which country, the categorization of a business, the entity that it sits within, and therefore it's more of an apples to apples comparison to look on a pre-tax basis. That's why taxes are added back. Next, you have depreciation and amortization. So depreciation is a non-cash expense. What that means is, for instance, if you buy lots of equipment for a manufacturing company or a distribution business, or you invest in certain expenses within a software company or call it more of an asset light business, there's certain things that tax authorities allow to be depreciated over time. And so what that means is the expense is made day one. However, given that the life of, let's say, the widget manufacturing machine is 10 years, there's going to be some time period beyond just that 1 year that the expense is incurred or accepted on the income statement of a business. So when you make that capital expenditure or investment within the company, it might be a 5-year, 7-year, it could be more accelerated depending on what the thing is that you're buying. However, that expense is recognized over a longer period of time, and it gets more complicated with accounting books versus tax books, but relatively speaking, that's how it happens. And the idea of that is that when an asset on the balance sheet is fully depreciated, that you'll need to go buy it again. That's used to be true. I think over time, the tax laws and kind of realities of businesses have deviated to some degree. However, the depreciation expense on the income statement is not a cash expense in the true sense of the cash is not being shelled out in that particular year. The same can be said about amortization. Amortization pertains more to goodwill and intangible assets on the balance sheet that can be left over from prior acquisitions or from other situations. And so again, irrespective of some of the complexities of what it represents, it is again a non-cash expense. And therefore, depreciation and amortization are non-cash expenses that are added back, again, to look at a truer version of what is the cash coming out of the business. So to recap this concept, EBITDA is a gauge of the cash flowing power of a business. It is the earnings, but it's adding back interest expenses, which are more pertinent to capitalization. It's adding back taxes, because everyone's taxes are going to be different and therefore better to look at it on a pre-tax basis. And then it adds back depreciation and amortization, which are both non-cash expenses. And so the idea of EBITDA or EBITDA is what's the truest kind of view that we can have of this company as to how much cash it generates, and how can we kind of set it against other companies within the industry or elsewhere and have somewhat of an apples to apples comparison. And so that's the foundational idea of the metric. We've talked in the past how that EBITDA is thereafter can be further recast, further adjusted to be more normalized in the sense of adding back non-recurring expenses, personal expenses, to get an even more accurate look at the cash flow power of a business. And then beyond that, you think of multiples, and that's the idea, is that the multiple someone pays for a company, they pay 6 times, 8 times, 10 times, is applied to that EBITDA, and moreover, that adjusted or normalized EBITDA. And so that's why it's a really, really important thing to get your arms around, to crystallize, and to incorporate as part of the narrative. But you'll hear this concept discussed in almost all of private equity, of corporate acquisitions, and anything finance oriented. And we've talked about it a lot of times in our videos as part of further analyses. But we wanted to make a video to specifically look at what is EBITDA, how is it calculated, and why is that metric utilized versus, say, purely just the net income or the net ordinary income or the operating income for a particular business. So that's the thought for today. Keep pushing forward. God bless. We'll see everyone next time.